Question 1. The investigation demonstrates that a large employer is transitioning to a self-funded health plan, engaging in administrative services only, a sole vendor for claims processing, and utilizing a stop-loss insurance policy to mitigate financial risk. As the underwriter responsible for assessing this arrangement, which of the following approaches best ensures compliance with U.S. federal and state regulations governing self-funded health plans? Option A. Focus primarily on the capabilities and reputation of the ASO vendor, assuming their administrative efficiency will indirectly safeguard the plan's financial health. Option B. Recommend that the employer convert the plan to a fully insured product to avoid the complexities and potential regulatory pitfalls of self-funding. Option C. Prioritize a comprehensive review of the stop-loss insurance policy's terms, limits, exclusions, and conditions to confirm it adequately protects the self-funded plan from catastrophic claims and aligns with regulatory requirements for risk transfer. Option D. Accept the stop-loss policy at face value, as any stop-loss coverage is generally considered sufficient for self-funded plans under ERISA. Correct answer is C. Prioritize a comprehensive review of the stop-loss insurance policy's terms, limits, exclusions, and conditions to confirm it adequately protects the self-funded plan from catastrophic claims and aligns with regulatory requirements for risk transfer. Explanation. This scenario presents a professional challenge because the underwriter must navigate the complexities of self-funded health plans, specifically the interplay between stop-loss insurance and administrative services only ASO arrangements, while adhering strictly to U.S. federal regulations, primarily ERISA, and relevant state insurance laws. The underwriter's role is to assess risk and ensure compliance, which requires a nuanced understanding of how these components interact to protect the employer and its employees. The challenge lies in accurately evaluating the financial stability and risk mitigation strategies of the self-funded plan, ensuring that the stop-loss coverage adequately addresses potential catastrophic claims without creating a de facto insured plan that would trigger different regulatory requirements. The correct approach involves a thorough review of the stop-loss policy's terms and conditions, focusing on coverage limits, exclusions, and the specific perils it covers. This approach is correct because it directly addresses the core function of stop-loss insurance in a self-funded environment, to protect the plan sponsor from excessive claims volatility. By verifying that the stop-loss policy is structured appropriately and aligns with the self-funded nature of the plan, the underwriter ensures compliance with ERISA provisions for self-funded plans and avoids inadvertently classifying the plan as an insured plan, which would subject it to state insurance mandates and potentially the ACA's requirements for fully insured plans. This meticulous examination upholds the integrity of the self-funded structure and the risk management strategy. An incorrect approach that focuses solely on the administrative services provided by the ASO vendor without adequately scrutinizing the stop-loss coverage is professionally unacceptable. This failure stems from a misunderstanding of the risk transfer mechanism. While ASO vendors manage claims and provide administrative functions, they do not assume the financial risk of claims. The stop-loss policy is the sole mechanism for risk transfer in this context. Overlooking or inadequately assessing the stop-loss policy means the underwriter has not properly evaluated the plan's financial protection against large claims, potentially exposing the employer to significant financial strain and violating the duty to accurately assess risk. Another incorrect approach would be to assume that any stop-loss policy automatically fulfills the risk mitigation needs of a self-funded plan without examining its specific provisions. This is a regulatory failure because stop-loss policies can vary significantly in their terms, and certain provisions might inadvertently create an insured plan or fail to provide adequate protection. For instance, aggregate stop-loss coverage that is too low or specific stop-loss coverage with overly broad exclusions could leave the self-funded plan vulnerable. This oversight could lead to noncompliance with ERISA and state insurance laws, as the plan may not be structured as intended or may be operating without sufficient financial safeguards. The professional decision-making process for similar situations should begin with a clear identification of the plan's structure, self-funded vs. fully insured. For self-funded plans, the underwriter must then dissect the components, paying particular attention to the stop-loss insurance. This involves a detailed review of the policy documents, understanding the coverage limits, deductibles, exclusions, and any conditions that might affect its validity or effectiveness. The underwriter should also consider the relationship between the stop-loss policy and the ASO arrangement, ensuring they are complementary and do not create unintended regulatory consequences. A robust risk assessment framework that prioritizes regulatory compliance and accurate risk transfer evaluation is essential. Question 2. During the evaluation of a variable universal life (VUL) insurance application, an underwriter identifies that the applicant has selected a sub-account portfolio with a high allocation to aggressive growth funds. The applicant is in their late 50s and has expressed a desire for significant cash value accumulation to supplement retirement income, but also wants a substantial death benefit. The underwriter is concerned about the potential volatility of the selected sub-accounts and its impact on both the cash value growth and the long-term viability of the death benefit, especially given the applicant's age and stated objectives. Which of the following approaches best reflects the underwriter's professional responsibility in this situation, considering the dual nature of VUL products and relevant U.S. regulatory frameworks? Option A. Recommend a policy with a guaranteed death benefit rider and a more conservative allocation of sub-accounts, ensuring the applicant understands the trade-offs in potential cash value growth. Option B. Focus solely on the universal life features, ensuring the policy is adequately funded for the death benefit and disregard the investment performance of the sub-accounts. Option C. Proceed with underwriting based on the mortality risk alone, assuming the applicant understands the investment risks as they selected the sub-accounts. Option D. Decline the application outright due to the perceived high investment risk, without further consultation or exploration of alternatives. The correct answer is C. Proceed with underwriting based on the mortality risk alone, assuming the applicant understands the investment risks as they selected the sub-accounts. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the complex interplay of features in a variable universal life (VUL) policy with the specific regulatory requirements governing such products. The underwriter must ensure that the policy's design and the underwriting decisions align with the principles of fair treatment of customers, accurate risk assessment, and compliance with disclosure obligations, all within the framework of the applicable U.S. securities and insurance regulations. A misstep can lead to regulatory sanctions, reputational damage, and financial harm to the client. The correct approach involves a thorough understanding of both the variable and universal life components of the policy and how they interact to affect the policy's performance, risk profile, and suitability for the applicant. This includes scrutinizing the proposed investment options, the policy's expense structure, and the potential for policy lapse or excessive withdrawals, all while ensuring that the applicant's financial situation and objectives are appropriately considered. Regulatory compliance, particularly concerning suitability and disclosure of investment risks, is paramount. This approach prioritizes the client's best interests and adherence to the Securities and Exchange Commission (SEC) and state insurance department regulations. An incorrect approach would be to focus solely on the life insurance aspects of the VUL policy without adequately considering the investment component and its associated risks. This failure to address the variable nature of the policy would violate SEC regulations requiring disclosure of investment risks and suitability assessments for securities products. Another incorrect approach would be to overlook the impact of policy fees and charges on the policy's long-term viability, potentially leading to an underfunded policy or a lapse, which could be seen as a failure to act in the client's best interest and a potential violation of state insurance laws regarding policy illustrations and solvency. Furthermore, neglecting to ensure the applicant fully understands the potential for investment losses and the impact on the death benefit and cash value would be a significant ethical and regulatory breach. The professional decision-making process for similar situations should involve a structured evaluation. First, identify the core product features and their regulatory implications. Second, assess the applicant's profile against the product's characteristics, focusing on suitability and risk tolerance. Third, ensure all required disclosures are made clearly and comprehensively, particularly regarding investment risks and fees. Finally, document the underwriting rationale and decisions, demonstrating compliance with all applicable laws and ethical standards. Question 3. Operational review demonstrates that an underwriter has accessed an applicant's credit report and noted the presence of several late payments and a high credit utilization ratio. The underwriter is considering declining the application based on this information. What is the most appropriate course of action for the underwriter to take, adhering strictly to U.S. regulatory frameworks governing the use of credit reports in insurance underwriting? Option A. Conduct a detailed review of the credit report to identify specific financial behaviors that directly correlate with increased mortality risk according to underwriting guidelines, and if adverse action is contemplated, ensure the applicant receives an adverse action notice and a copy of the credit report. Option B. Proceed with underwriting without further consideration of the credit report, assuming the information is not directly relevant to mortality risk. Option C. Use the credit report information to assess the applicant's general financial stability for marketing purposes, unrelated to the underwriting decision. Option D. Decline the application immediately and inform the applicant that their credit history indicates a higher risk. The correct answer is D. Decline the application immediately and inform the applicant that their credit history indicates a higher risk. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the need for accurate risk assessment with the imperative to comply with privacy regulations and ethical considerations regarding the use of credit report information. The underwriter must understand the permissible uses of credit reports in life insurance underwriting, recognizing that while financial responsibility is a relevant factor, the information obtained must be used judiciously and in accordance with established legal and ethical boundaries. The core of the challenge lies in interpreting the adverse action notification requirement and ensuring that any decision based on credit report data is both justified by underwriting guidelines and compliant with consumer protection laws. The correct approach involves a thorough review of the credit report to identify specific financial indicators that directly relate to insurability and underwriting guidelines, such as evidence of severe financial distress or mismanagement that could increase mortality risk. This approach is correct because it aligns with the permissible uses of credit reports in underwriting, which are generally limited to assessing financial responsibility and its impact on mortality. Specifically, under regulations like the Fair Credit Reporting Act, FCRA, in the U.S., if an insurer intends to take adverse action based on information in a credit report, they must provide the applicant with a notice of adverse action. This notice informs the applicant of the decision and provides them with a copy of the credit report and information on how to dispute inaccuracies. This ensures transparency and allows the applicant to understand the basis of the decision and correct any errors, upholding both legal compliance and ethical treatment of the applicant. An incorrect approach would be to automatically decline coverage solely based on the presence of a credit report, without a detailed analysis of the specific information contained within it. This fails to acknowledge that credit reports can contain various types of information, some of which may not be directly indicative of increased mortality risk, or may be outdated or inaccurate. Ethically, this is problematic as it can lead to unfair discrimination. Legally, it may violate FCRA requirements if adverse action is taken without proper notification and opportunity for the applicant to respond. Another incorrect approach would be to use the credit report information for purposes beyond assessing financial responsibility and insurability, such as for marketing or other non-underwriting related decisions. This is a clear violation of privacy regulations and the permissible uses of consumer credit information. The FCRA strictly limits how credit report information can be used, and any deviation from these permitted uses constitutes a significant legal and ethical breach. A third incorrect approach would be to fail to provide the applicant with the required adverse action notice if the credit report information leads to a decline or modification of coverage. This omission deprives the applicant of their right to know the basis of the decision and to dispute any inaccuracies, directly contravening consumer protection laws and ethical principles of fairness and transparency in the underwriting process. The professional decision-making process for similar situations should involve a systematic evaluation of the credit report data against established underwriting guidelines. This includes identifying specific adverse information that directly impacts mortality risk. If this information leads to a potential adverse action, the underwriter must then ensure all regulatory requirements, such as providing the adverse action notice and a copy of the credit report, are met. This process prioritizes accurate risk assessment while upholding legal obligations and ethical standards of fairness and transparency. Question 4. Cost-benefit analysis shows that a variable annuity with a diversified range of separate account investment options, including equity-based funds, could offer significant growth potential. However, the client, a retiree with a low risk tolerance and a need for capital preservation, expresses interest in these growth prospects. What is the most appropriate course of action for the underwriter? Option A. Recommend a variable annuity with a guaranteed minimum withdrawal benefit rider, focusing on the income stream it provides, without fully detailing the market risks of the underlying separate account investments. Option B. Decline to recommend the variable annuity, explaining that the product's inherent market risk and the potential for capital loss in its separate account investment options are not aligned with the client's stated low risk tolerance and capital preservation needs. Option C. Proceed with the sale, emphasizing the potential for market gains and explaining that the client can switch investment options within the separate account if market conditions change. Option D. Advise the client to invest in a fixed annuity instead, as it offers principal protection, without exploring if any variable annuity subaccounts could be managed to mitigate risk for this client. The correct answer is C. Proceed with the sale, emphasizing the potential for market gains and explaining that the client can switch investment options within the separate account if market conditions change. Explanation. This scenario presents a professional challenge because the underwriter must balance the client's stated investment objectives and risk tolerance with the inherent complexities and risks of variable annuities, particularly concerning separate account performance and market volatility. The FALU designation implies a commitment to ethical conduct and adherence to regulatory standards, necessitating a thorough understanding of product suitability and disclosure requirements. The underwriter's judgment is critical in ensuring the client receives accurate information and that the chosen investment options align with their financial goals and capacity for risk. The correct approach involves a comprehensive assessment of the client's financial situation, investment objectives, and risk tolerance, followed by a detailed explanation of the variable annuities features, including the risks associated with the separate accounts investment options and market fluctuations. This approach is correct because it aligns with the regulatory framework governing variable annuities, which mandates suitability assessments and robust disclosure of risks. Specifically, regulations like those under the Securities and Exchange Commission, SEC, and FINRA in the U.S. require that investment recommendations be suitable for the client and that all material risks, including market risk affecting separate accounts, be clearly communicated. Ethical considerations also demand that the underwriter acts in the client's best interest, prioritizing transparency and informed decision-making. An incorrect approach would be to proceed with the sale based solely on the client's expressed interest in potential market gains, without adequately probing their understanding of the associated risks or their capacity to absorb potential losses. This failure to conduct a thorough suitability assessment and provide comprehensive risk disclosure violates regulatory requirements. It exposes the client to undue risk and could lead to misrepresentation or omission of material facts, resulting in regulatory sanctions and reputational damage. Another incorrect approach would be to overemphasize the potential for high returns from aggressive investment options within the separate account, downplaying the impact of market downturns. This misrepresentation of risk is a direct violation of disclosure obligations and ethical principles. It creates a false sense of security for the client and fails to meet the standard of care expected of a qualified professional. A third incorrect approach would be to recommend investment options within the separate account that are clearly misaligned with the client's stated risk tolerance, even if they offer higher potential returns. This demonstrates a lack of due diligence and a failure to prioritize the client's financial well-being over potential commission. It is a breach of both regulatory suitability rules and professional ethics. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client. Conduct a thorough fact-finding process to ascertain the client's financial situation, investment objectives, time horizon, and risk tolerance. 2. Product knowledge. Possess a deep understanding of the variable annuity product, including its features, benefits, costs, and crucially, the risks associated with its separate account investment options and market sensitivity. 3. Suitability assessment. Objectively evaluate whether the variable annuity and its proposed investment options are suitable for the client based on the information gathered in Step 1. 4. Disclosure and education. Clearly and comprehensively explain all material aspects of the product, including fees, surrender charges, tax implications, and most importantly, the risks of market volatility and potential loss of principal associated with the separate account investments. 5. Documentation. Maintain detailed records of the client's financial profile, the suitability assessment, and all disclosures provided. Question 5. Comparative studies suggest that plan sponsors of 401(k) plans often face challenges in selecting and monitoring investment options. When reviewing the investment lineup for a 401(k) plan to ensure compliance with fiduciary responsibilities under ERISA, which of the following approaches best demonstrates adherence to regulatory requirements and professional best practices? Option A. Relying on the assumption that all investment options provided by a well-known mutual fund company are inherently prudent and cost-effective. Option B. Conducting a thorough due diligence process that includes evaluating investment objectives, risk profiles, historical performance, and the reasonableness of fees for each investment option, coupled with ongoing monitoring. Option C. Prioritizing investment options that are offered by the same financial institution that provides record-keeping services for the plan, assuming this simplifies administration. Option D. Selecting investment options, primarily based on their widespread availability and recognition among plan participants. The correct answer is B. Conducting a thorough due diligence process that includes evaluating investment objectives, risk profiles, historical performance, and the reasonableness of fees for each investment option, coupled with ongoing monitoring. Explanation. This scenario presents a professional challenge due to the inherent fiduciary responsibilities associated with administering defined contribution plans, specifically 401(k) plans, under the Employee Retirement Income Security Act of 1974, ERISA. Plan sponsors and fiduciaries must act solely in the interest of plan participants and beneficiaries, exercising the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use in the conduct of an enterprise of a like character and with like aims. The complexity arises when evaluating investment options, as fiduciaries must ensure that the selected investments are appropriate for the plan's objectives and participants' needs, and that any associated fees are reasonable. A failure to conduct thorough due diligence or to monitor investment performance and fees can lead to breaches of fiduciary duty, resulting in significant liability for the plan sponsor and fiduciaries. The correct approach involves a comprehensive review of the investment lineup, focusing on the prudence of selection and ongoing monitoring of performance and expenses. This aligns with ERISA fiduciary standards, particularly the duty of prudence, 29 CFR Section 2550, 404A1, and the duty to diversify investments ERISA Section 404A1. C. Fiduciaries must demonstrate that they have established and followed a prudent process for selecting and monitoring investment options, including a thorough analysis of investment objectives, risk profiles, historical performance, and, critically, the reasonableness of fees in relation to the services provided and the investment's characteristics. This proactive and diligent approach is essential for fulfilling fiduciary obligations and protecting plan participants. An incorrect approach that relies solely on the popularity of an investment option overlooks the fiduciary's responsibility to conduct independent due diligence. Popularity does not equate to prudence or suitability for the plan's participants. This approach risks selecting underperforming or excessively expensive investments, thereby breaching the duty of loyalty and prudence. Another incorrect approach, which involves selecting investments based on the perceived ease of administration, also fails to meet ERISA fiduciary standards. While administrative efficiency is a consideration, it cannot supersede the primary obligation to select prudent and cost-effective investment options for participants. This approach prioritizes the sponsor's convenience over the participant's best interests, constituting a breach of fiduciary duty. Finally, an approach that assumes all mutual funds offered by a reputable provider are inherently suitable and reasonable in cost fails to acknowledge the fiduciary's ongoing monitoring responsibilities. Even reputable providers can offer funds with varying performance and fee structures. Fiduciaries must continuously evaluate the entire investment lineup to ensure it remains appropriate and cost-effective, rather than relying on a blanket assumption of suitability. The professional decision-making process for similar situations should involve establishing a clear investment policy statement outlining the plan's investment objectives, risk tolerance, and criteria for selecting and monitoring investment options. Fiduciaries should engage qualified investment advisors, conduct thorough due diligence on all proposed investment options, regularly review investment performance against benchmarks, and critically assess all fees and expenses associated with the plan's investments. Documentation of all decisions and the rationale behind them is crucial for demonstrating compliance with fiduciary responsibilities. Question 6. Stakeholder feedback indicates a potential misunderstanding by a prospective client regarding the guaranteed interest rate and fixed payment structure of a proposed fixed annuity. The agent has assured the underwriting department that the client fully comprehends the product's features, but the feedback suggests the client may be expecting returns or payment stability beyond what the policy contract explicitly guarantees, potentially influenced by marketing materials or prior discussions that emphasize the guaranteed aspect without fully detailing the underlying conditions and limitations. As the underwriter, what is the most appropriate course of action to ensure regulatory compliance and ethical practice? Option A. Request further clarification from the agent regarding the client's understanding. Review all disclosure documents provided to the client, and ensure the policy contract clearly reiterates the terms of the guaranteed interest rate and fixed payments, potentially recommending a follow-up conversation with the client to confirm comprehension before policy issuance. Option B. Proceed with underwriting based on the agent's assurance that the client understands the product, assuming the agent has fulfilled their disclosure obligations. Option C. Immediately reject the application due to the potential for misrepresentation, without further investigation into the specifics of the client's understanding. Option D. Forward the feedback to the sales management team for internal review, but continue with the underwriting process as planned, assuming the issue will be resolved at the sales level. The correct answer is A. Request further clarification from the agent regarding the client's understanding, review all disclosure documents provided to the client, and ensure the policy contract clearly reiterates the terms of the guaranteed interest rate and fixed payments, potentially recommending a follow-up conversation with the client to confirm comprehension before policy issuance. Explanation. This scenario presents a professional challenge because it requires balancing the client's immediate financial needs and understanding with the insurer's contractual obligations and regulatory requirements concerning fixed annuities. The underwriter must navigate potential misrepresentations or misunderstandings about the product's guarantees, ensuring the client is fully informed and that the underwriting process upholds ethical standards and regulatory compliance. Careful judgment is required to avoid both overpromising and underdelivering, and to ensure the client's expectations align with the product's reality. The correct approach involves a thorough review of the application and supporting documentation, a clear and transparent communication with the agent, and potentially the client regarding the specific terms and limitations of the guaranteed interest rate and fixed payments, and ensuring all disclosures are accurate and compliant with relevant regulations. This approach is ethically sound and regulatorily compliant because it prioritizes informed consent and accurate representation of the product. It adheres to the principle of acting in the client's best interest by ensuring they understand the product they are purchasing, particularly the fixed nature of the guarantees, which are subject to the insurer's financial strength and the terms of the contract. This aligns with general principles of fair dealing and consumer protection expected in insurance underwriting. An incorrect approach would be to proceed with underwriting based solely on the agent's assurance without independent verification or further clarification. This fails to uphold the underwriter's responsibility to ensure the accuracy of information, and could lead to the issuance of a policy based on a misunderstanding of the product's guarantees, potentially exposing the insurer to adverse selection or regulatory scrutiny for misrepresentation. Another incorrect approach would be to dismiss the stakeholder feedback without further investigation, assuming the agent is acting appropriately. This neglects the underwriter's duty to investigate potential red flags and ensure compliance, potentially overlooking a systemic issue or a pattern of misrepresentation. A third incorrect approach would be to immediately reject the application without attempting to clarify the situation or gather more information. While caution is necessary, an outright rejection without due diligence may be premature and could unfairly penalize the applicant. If the issue is a simple misunderstanding, that can be rectified through clear communication and accurate disclosures. The professional decision-making process for similar situations should involve a systematic approach. First, acknowledge and investigate stakeholder feedback. Second, gather all relevant facts and documentation. Third, consult internal guidelines and regulatory requirements. Fourth, communicate clearly and transparently with all parties involved. Fifth, make a decision based on a comprehensive understanding of the facts, ethical consideration, and regulatory obligations. And finally, document the decision-making process thoroughly. Question 7. Investigation of a life insurance application reveals that the applicant, who has a history of a chronic but stable condition, is requesting a waiver of premium rider, a guaranteed insurability rider, and an accelerated death benefit rider. The agent has expressed concern that the applicant's condition might lead to denial of these riders and has urged the underwriter to approve them to ensure the policy is issued. What is the most ethically and regulatorily sound approach for the underwriter? Option A. Approve all requested riders after a thorough review of the applicant's medical history and underwriting guidelines, making adjustments or imposing specific limitations if necessary and clearly communicating these to the applicant and agent. Option B. Approve the waiver of premium rider without further underwriting to accommodate the agent's request and ensure policy issuance, as the applicant's condition is described as stable. Option C. Deny all optional riders outright due to the applicant's pre-existing chronic condition, assuming it automatically disqualifies them from all such benefits. Option D. Approve all requested riders, but omit any discussion of potential limitations or exclusions related to the applicant's pre-existing condition in the policy contract or communications. The correct answer is A. Approve all requested riders after a thorough review of the applicant's medical history and underwriting guidelines, making adjustments or imposing specific limitations if necessary and clearly communicating these to the applicant and agent. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's perceived immediate need and the underwriting principles designed to ensure long-term policy viability and fairness to all policyholders. The underwriter must balance the client's desire for immediate coverage with the insurer's responsibility to assess risk accurately and avoid adverse selection. Careful judgment is required to uphold ethical standards and regulatory compliance without alienating the client. The correct approach involves a thorough and transparent review of the application, including the rider requests, and communicating the underwriting decision and its rationale clearly to the client and their agent. This approach upholds the principle of utmost good faith by ensuring all material facts are considered and that the policy issued accurately reflects the risk. It aligns with regulatory expectations that insurers operate with integrity and provide accurate information to consumers. Specifically, it adheres to the principle that all riders must be underwritten based on the applicant's current health and risk profile, and that misrepresentation or omission of material facts can lead to policy rescission or denial of claims. Transparency in explaining the underwriting decision, even if it results in a denial of a rider, is crucial for maintaining client trust and demonstrating adherence to fair practices. An incorrect approach would be to approve the waiver of premium rider without proper underwriting, simply to appease the client or agent. This fails to uphold the insurer's duty to underwrite all policy components based on risk, potentially exposing the insurer to increased claims if the applicant's health deteriorates in a way that would have precluded rider approval. This also violates the ethical obligation to ensure policy terms are appropriate for the risk assumed. Another incorrect approach would be to deny all riders without a thorough review, assuming the client's pre-existing condition automatically disqualifies them from all optional benefits. This demonstrates a lack of due diligence and can be seen as discriminatory if not based on objective underwriting guidelines. It fails to explore whether certain riders, like guaranteed insurability, might still be appropriate under specific conditions, or if other riders, like accelerated death benefits, could be offered with appropriate adjustments. Finally, an incorrect approach would be to approve the riders, but fail to disclose any limitations or exclusions related to the pre-existing condition that might affect their future usability. This lack of transparency can lead to client dissatisfaction and potential disputes when a claim arises, undermining the insurer's commitment to clear communication and fair dealing. The professional decision-making process should involve 1. a complete review of the application and all supporting documentation. 2. Application of established underwriting guidelines to each requested rider, considering the applicant's medical history and lifestyle. 3. Consultation with underwriting management or medical directors if the case presents complex risk factors. 4. Clear and concise communication of the underwriting decision, including any approvals, denials, or modifications, along with the reasons for these decisions, to the applicant and their agent. 5. Ensuring all communications are documented thoroughly. Question 8. The control framework reveals a scenario where an underwriter is reviewing an application for a substantial life insurance policy. The applicant has disclosed a history of a resolved medical condition that, while documented as resolved, presents a potential for future complications based on industry actuarial data. The underwriter needs to gather further medical information to accurately assess the mortality risk. Which of the following represents the most appropriate and compliant approach to obtaining this necessary medical information? Option A. Proceed with policy issuance based solely on the applicant's self-reported medical history, assuming the condition is truly resolved as stated, to avoid any potential delays or applicant dissatisfaction. Option B. Inform the applicant that due to the disclosed condition, a mandatory waiting period of 6 months will be imposed, during which time they must undergo regular medical checkups at their own expense before the application can be re-evaluated. Option C. Immediately request a comprehensive medical examination including full blood work, an ECG, and a chest X-ray, along with an attending physician statement (APS) for all previously treated conditions. Option D. Request an attending physician statement (APS), specifically detailing the treatment, resolution, and prognosis of the disclosed resolved medical condition, and only consider further medical exams or lab tests if the APS reveals significant ongoing concerns or insufficient detail. The correct answer is C. Immediately request a comprehensive medical examination including full blood work, an ECG, and a chest X-ray, along with an attending physician statement (APS) for all previously treated conditions. Explanation. The control framework reveals a scenario where an underwriter must balance the need for comprehensive medical information to accurately assess risk with the ethical and regulatory obligations to protect applicant privacy and ensure fair treatment. The challenge lies in obtaining necessary attending physician statements (APS), medical exams, and lab tests without causing undue delay, expense, or distress to the applicant, while strictly adhering to the underwriting guidelines and regulatory requirements of the relevant jurisdiction. This requires a nuanced understanding of when each type of medical information is truly necessary and how to request it in a compliant and professional manner. The best practice approach involves a systematic and risk-based evaluation of the application. This means initially assessing the available information and determining if the underwriting can proceed without further medical evidence. If additional information is required, the underwriter must then identify the minimum necessary information to clarify the risk. This typically involves requesting an APS for specific conditions that are not fully disclosed or appear significant. Medical exams and lab tests are generally reserved for cases where the APS is insufficient, the risk is exceptionally high, or the application falls into a specific underwriting class that mandates such testing. The process must be documented, and the applicant informed of the requirements and their rights. This approach aligns with regulatory principles of fairness, non-discrimination, and data privacy, ensuring that information is obtained only when justified by the underwriting risk and in a manner that respects the applicant's rights. An incorrect approach would be to routinely request a full medical exam and extensive lab tests for all applications, regardless of the apparent risk. This is professionally challenging because it is inefficient, costly for both the applicant and the insurer, and potentially intrusive. Ethically, it can be seen as discriminatory if applied without justification, and it violates the principle of obtaining only necessary information. Regulatory failure would stem from potential violations of privacy laws and unfair claims settlement practices if such broad testing leads to unnecessary delays or denials without proper justification. Another incorrect approach would be to rely solely on the applicant's self-reported medical history without seeking any external verification, even when red flags or inconsistencies are present. This is professionally challenging as it significantly increases the risk of adverse selection and misrepresentation, leading to potential financial losses for the insurer and ethical breaches if claims are later disputed due to undisclosed conditions. Regulatory failure would occur if this practice leads to the issuance of policies based on incomplete or inaccurate information, potentially violating solvency requirements or leading to accusations of misrepresentation in claims handling. A third incorrect approach would be to delay the underwriting process excessively by making multiple, uncoordinated requests for medical information without a clear plan or justification. This is professionally challenging because it frustrates applicants, damages the insurer's reputation, and can lead to lost business. Ethically, it demonstrates a lack of diligence and respect for the applicant's time and effort. Regulatory failure could arise from unreasonable delays in policy issuance, potentially violating regulations that mandate timely underwriting decisions or fair treatment of applicants. The professional decision-making process for similar situations involves a thorough review of the application and supporting documents, identifying any gaps or areas of concern. This is followed by a risk assessment to determine the level of additional medical information required. The underwriter must then select the most appropriate and least intrusive method to obtain that information, adhering to established underwriting guidelines and regulatory mandates. Transparency with the applicant throughout the process is crucial, ensuring they understand the reasons for the requests and their rights. Continuous professional development and understanding evolving medical information and regulatory landscapes is also vital. Question 9. Risk assessment procedures indicate a client seeking a life insurance policy for lifelong protection with a desire for predictable premium payments and guaranteed cash value accumulation. The client has expressed concern about market volatility and prefers a product with a stable death benefit. Which of the following approaches best aligns with the client's stated needs and regulatory requirements for recommending whole life insurance products? Option A. Recommending an indexed life insurance policy, emphasizing its connection to market performance and potential for enhanced cash value growth. Option B. Recommending a variable life insurance policy, highlighting its potential for investment growth and flexibility in premium payments. Option C. Recommending a traditional whole life insurance policy or a limited payment whole life insurance policy, ensuring clear disclosure of premium structures and cash value guarantees. Option D. Recommending a single premium whole life insurance policy, focusing on the immediate establishment of a death benefit and tax-deferred cash value growth. The correct answer is C. Recommending a traditional whole life insurance policy or a limited payment whole life insurance policy, ensuring clear disclosure of premium structures and cash value guarantees. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the client's stated objectives with the regulatory requirements and ethical obligations governing the sale of life insurance products, specifically focusing on the nuances of whole life insurance variations. The underwriter must ensure that the product recommended and underwritten accurately reflects the client's needs and risk profile, while also adhering to disclosure and suitability standards. Misrepresenting product features or failing to adequately explain the implications of different policy types can lead to regulatory violations and client dissatisfaction. The correct approach involves a thorough needs analysis and a clear explanation of how each whole life variation meets those needs, emphasizing the differences in premium structure, cash value accumulation, and death benefit guarantees. This aligns with regulatory frameworks that mandate suitability and fair dealing, requiring that recommendations be in the client's best interest. Specifically, for a client seeking long-term protection with predictable costs and guaranteed cash value growth, a traditional or limited payment whole life policy would be appropriate. The underwriter must ensure the client understands the premium commitment for limited payment policies and the potential for higher initial premiums in single premium policies, while also clarifying that adjustable life policies offer flexibility, but may not guarantee the same level of long-term cash value growth as traditional whole life. Interest-sensitive, variable, and index policies, while variations of whole life introduce market-linked components that require more extensive disclosure regarding risk and potential for fluctuating cash values and death benefits, which may not align with a client seeking guaranteed outcomes. An incorrect approach would be to recommend a variable life policy solely because it offers potential for higher cash value growth without fully disclosing the investment risks, the impact of market volatility on the death benefit, and the associated fees and charges. This fails to meet the suitability requirements and could be construed as misrepresentation, as it does not align with a client seeking guaranteed long-term protection and predictable costs. Another incorrect approach would be to recommend an indexed life policy without adequately explaining how the index performance affects the cash value and death benefit, and the limitations on participation in market gains, potentially misleading the client about the guaranteed nature of the product. Recommending a single premium whole life policy without confirming the client's capacity to fund the entire premium upfront and understanding the implications for liquidity would also be an inappropriate recommendation, as it may not align with the client's financial situation and objectives. Professional decision-making in such situations requires a systematic process. First, conduct a comprehensive fact-finding to understand the client's financial situation, objectives, risk tolerance, and time horizon. Second, educate the client on the various product types available, clearly explaining their features, benefits, risks, and costs, using plain language. Third, match the client's profile to the most suitable product, ensuring that the recommendation is in the client's best interest and complies with all regulatory requirements for disclosure and suitability. Finally, document the entire process, including the needs analysis, product recommendation, and client's understanding and consent. Question 10. The review process indicates that a client, a self-employed individual with significant self-employment income, is requesting to establish a Roth IRA. The client states they want to contribute the maximum allowable amount and believes a Roth IRA is the best option for tax-free growth and withdrawals in retirement. However, the underwriter notes that the client's reported income for the current year is at the upper limit for Roth IRA contributions. Which of the following represents the most appropriate course of action for the underwriter? Option A. Suggest the client open a SEP IRA, as this is designed for self-employed individuals and allows for higher contribution limits. Option B. Recommend the client open a traditional IRA and contribute the maximum amount, as this will provide a tax deduction now, which is generally beneficial. Option C. Advise the client that based on their current income, they may exceed the Roth IRA contribution limits and explain the income limitations for direct Roth IRA contributions, suggesting they explore backdoor Roth IRA contributions or a traditional IRA if they wish to contribute more. Option D. Proceed with establishing the Roth IRA for the client and allow them to contribute the maximum amount, assuming the client is aware of their income and its implications. The correct answer is C. Advise the client that based on their current income, they may exceed the Roth IRA contribution limits and explain the income limitations for direct Roth IRA contributions, suggesting they explore backdoor Roth IRA contributions or a traditional IRA if they wish to contribute more. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated desire and the underwriter's fiduciary duty to ensure compliance with regulatory requirements and ethical best practices. The underwriter must navigate the client's potentially misinformed intentions while upholding the integrity of retirement savings vehicles and avoiding misrepresentation. Careful judgment is required to balance client service with regulatory adherence. The correct approach involves educating the client about the specific rules and limitations of each IRA type, particularly regarding contribution eligibility and withdrawal penalties, and then guiding them toward the most suitable option based on their circumstances and the regulations. This upholds the underwriter's ethical obligation to provide accurate information and act in the client's best interest, ensuring compliance with IRS regulations governing IRAs. An incorrect approach would be to simply process the client's request for a Roth IRA without verifying their eligibility based on income limits. This would violate the underwriter's duty to ensure compliance with IRS regulations, potentially leading to penalties for the client and reputational damage for the underwriter and their firm. Another incorrect approach would be to suggest a traditional IRA solely because it allows for tax-deductible contributions without exploring the client's long-term financial goals and tax situation, which might make a Roth IRA more advantageous if they qualify. This fails to provide comprehensive advice tailored to the client's needs. Finally, suggesting a simple IRA without confirming the client's employer status and the employer's eligibility would be a regulatory failure, as simple IRAs are employer-sponsored plans. The professional decision-making process for similar situations should involve a thorough needs assessment, clear communication of regulatory requirements and product features, and a commitment to providing advice that aligns with both the client's objectives and legal/ethical standards. Underwriters must be proactive in identifying potential compliance issues and educating clients to prevent errors and ensure the suitability of financial products. Question 11. Compliance review shows that a defined benefit pension plan's actuarial valuation report indicates a healthy current funded ratio, but the benefit formula includes a provision for early retirement with unreduced benefits, and the actuarial assumptions used for retirement age appear to be quite optimistic. Which of the following approaches best reflects a prudent underwriting risk assessment for this plan? Option A. Conduct a detailed review of the actuarial assumptions related to retirement age and early retirement provisions, and assess their impact on projected future funding requirements and the overall risk profile of the plan. Option B. Rely on the plan sponsor's assurance that the plan is well managed and that any actuarial complexities have been adequately addressed by their appointed actuary. Option C. Focus solely on the current year's contribution amount to ensure it meets minimum funding standards, as this is the primary indicator of financial stability. Option D. Accept the plan at face value, as the current funded ratio is strong and the actuary's assumptions are presumed to be sound. The correct answer is D. Accept the plan at face value, as the current funded ratio is strong and the actuary's assumptions are presumed to be sound. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the fiduciary duty to the plan sponsor and participants with the need to accurately assess and price risk for the insurer. The underwriter must understand the nuances of defined benefit plan funding to avoid misrepresenting the plan's financial health or the associated risks, which could lead to adverse selection or inadequate pricing. Careful judgment is required to interpret the actuarial information within the context of regulatory requirements and the specific plan provisions. The correct approach involves a thorough review of the plan's actuarial valuation report, focusing on the benefit formulas and the assumptions used to determine funding requirements. This includes verifying that the benefit formulas are clearly defined and consistently applied, and that the actuarial assumptions used, e.g., mortality, retirement age, salary increases, are reasonable and reflect the plan's experience and future expectations. The underwriter must also assess the plan's funding status, considering both the current funded ratio and any trends in underfunding or overfunding. This approach is correct because it directly addresses the core components of defined benefit plan risk from a life underwriting perspective. It aligns with the regulatory framework's emphasis on accurate risk assessment and the ethical obligation to ensure that the insurance product accurately reflects the underlying liabilities and risks of the pension plan. By scrutinizing the benefit formulas and funding requirements, the underwriter can identify potential areas of increased risk, such as overly generous benefit formulas or aggressive actuarial assumptions that might mask a plan's true financial condition. An incorrect approach would be to solely rely on the plan sponsor's assertion that the plan is adequately funded without independent verification of the actuarial assumptions and calculations. This fails to meet the underwriter's responsibility to conduct due diligence and could lead to the insurer accepting a risk that is not properly understood or priced. It violates the regulatory principle of prudent risk management and the ethical duty to avoid misrepresentation. Another incorrect approach would be to focus exclusively on the current year's contribution amount, without considering the long-term implications of the benefit formulas and actuarial assumptions on future funding requirements. This overlooks the potential for future deficits that could impact the plan's ability to meet its obligations, thereby increasing the risk to the insurer. This approach is flawed because it neglects the forward-looking nature of actuarial valuations and the potential for evolving liabilities. A third incorrect approach would be to disregard any discrepancies between the stated benefit formulas and the actuarial assumptions used in the valuation, assuming that the actuary has adequately addressed them. This demonstrates a lack of critical analysis and a failure to exercise professional skepticism. The underwriter has a responsibility to understand how the benefit formulas translate into liabilities and how the actuarial assumptions influence the funding requirements. Ignoring potential inconsistencies could lead to an underestimation of risk. The professional decision-making process for similar situations should involve a systematic review of all available plan documentation, including the plan document, trust agreement, and actuarial valuation reports. The underwriter should actively question any assumptions or calculations that appear unreasonable or inconsistent. Collaboration with the plan's actuary and legal counsel may be necessary to gain a comprehensive understanding of the plan's structure, liabilities, and funding status. The ultimate goal is to ensure that the underwriting decision is based on a complete and accurate assessment of the risks associated with the defined benefit plan. Question 12. Assessment of an underwriter's ethical and regulatory obligations when reviewing an application for a long-term disability income policy where the applicant has disclosed a history of intermittent back pain, but the specific details regarding the frequency, duration, and impact on daily activities are vague, and the policy has a 90-day elimination period and a 5-year benefit period. Option A. Request all medical records from the applicant's entire medical history, regardless of relevance to the back pain or the disability policy, to ensure a comprehensive understanding of their health. Option B. Deny the application outright due to the undisclosed severity of the back pain, citing potential future claims. Option C. Assume the back pain is a minor, manageable condition and proceed with underwriting the policy without further inquiry, as the applicant has disclosed it. Option D. Request a detailed medical report from the applicant's physician, specifically outlining the diagnosis, treatment history, prognosis, and any limitations related to the back pain, and clearly explain to the applicant why this information is necessary for underwriting the long-term disability policy. The correct answer is D. Request a detailed medical report from the applicant's physician, specifically outlining the diagnosis, treatment history, prognosis, and any limitations related to the back pain, and clearly explain to the applicant why this information is necessary for underwriting the long-term disability policy. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the insurer's need for accurate risk assessment with the applicant's right to privacy and the ethical obligation to avoid misrepresentation. The underwriter must navigate the complexities of disability income insurance definitions and the potential for pre-existing conditions to impact coverage, all while adhering to strict regulatory guidelines regarding information gathering and disclosure. The temptation to make assumptions based on incomplete information or to push for unnecessary disclosures can lead to ethical breaches and regulatory violations. The correct approach involves a thorough review of the submitted medical information, a clear understanding of the policy's definition of disability and elimination/benefit periods, and a direct, transparent communication with the applicant regarding any specific information needed to accurately underwrite the policy. This approach prioritizes obtaining all necessary information to assess risk fairly and accurately, without overstepping boundaries or creating undue burden on the applicant. It aligns with the FALU ethical standards and regulatory requirements that mandate accurate underwriting based on complete and verifiable information, while respecting applicant privacy and avoiding discriminatory practices. Specifically, it adheres to the principle of underwriting based on established risk factors and policy terms, ensuring that the applicant receives coverage that accurately reflects their risk profile and the policy's provisions. An incorrect approach that involves making assumptions about the applicant's health status based on a general medical history without specific inquiry into the nature, duration, and severity of any disclosed conditions is a failure to conduct thorough underwriting. This can lead to misclassification of risk, potentially resulting in adverse selection for the insurer or denial of a valid claim later. Another incorrect approach, which is to request extensive, unnecessary medical records beyond what is directly relevant to the underwriting of the specific disability income policy and the applicant's stated health, violates privacy regulations and can be perceived as intrusive and discriminatory. This goes beyond the scope of legitimate underwriting inquiry. Finally, an approach that involves pressuring the applicant to disclose information that is not directly pertinent to the underwriting of the disability income policy or that is protected by privacy laws is an ethical and regulatory failure. It undermines trust and can lead to legal repercussions. The professional decision-making process for similar situations should involve a systematic approach. First, clearly define the underwriting requirements based on the specific policy being applied for, including its definitions of disability, elimination periods, and benefit periods. Second, Meticulously review all submitted application information and medical reports. Third, identify any gaps or ambiguities that require clarification. Fourth, formulate specific, targeted questions or requests for additional information that are directly relevant to assessing the risk for the disability income coverage. Fifth, communicate these requests clearly and respectfully to the applicant, explaining the necessity for the information. Finally, ensure all actions comply with applicable privacy laws and ethical guidelines for insurance professionals. Question 13. Upon reviewing an application for a substantial life insurance policy, the underwriter notes that the applicant has disclosed a history of a chronic but well-managed medical condition, and also belongs to an ethnic group that has historically been associated with a higher incidence of certain health issues in population studies. The underwriter must determine the appropriate underwriting action. Which of the following approaches best aligns with regulatory requirements and ethical underwriting practices? Option A. Decline coverage or impose a significantly higher premium based on the applicant's ethnic background, assuming a higher inherent risk. Option B. Conduct a thorough review of the applicant's specific medical history, lifestyle factors, and occupation, assessing the impact of the disclosed condition on their individual mortality risk, while disregarding ethnic background as a basis for underwriting. Option C. Proceed with standard underwriting without further investigation into the disclosed medical condition or considering the applicant's ethnic background. Option D. Request detailed information about the applicant's family's genetic predispositions and social support network to assess overall life expectancy. Correct answer is A. Decline coverage or impose a significantly higher premium based on the applicant's ethnic background, assuming a higher inherent risk. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the underwriter to balance the need for accurate risk assessment with the potential for discriminatory practices, all while adhering to strict regulatory guidelines. The underwriter must navigate the complexities of individual risk factors without resorting to prohibited classifications. The pressure to maintain profitability for the insurer must be weighed against the ethical imperative to treat all applicants fairly and equitably. Correct approach analysis. The correct approach involves a thorough review of the applicant's medical history, lifestyle, and occupation, focusing on objective, quantifiable risk factors that are directly related to mortality or morbidity. This aligns with the principles of sound underwriting, which mandate that decisions be based on individual risk assessment rather than broad generalizations or prohibited categories. Specifically, under the regulatory framework governing life underwriting in the United States, insurers are prohibited from using race, religion, national origin, or other protected characteristics as a basis for underwriting decisions. The focus must remain on factors that demonstrably impact the likelihood of a claim, such as pre-existing conditions, smoking status, or hazardous occupations, as permitted by state and federal laws. Incorrect approaches analysis. One incorrect approach would be to automatically decline coverage or impose a significantly higher premium based solely on the applicant's stated ethnicity. This is a direct violation of anti-discrimination laws, such as those enforced by the National Association of Insurance Commissioners, NAIC, model laws and state-specific statutes, which prohibit unfair discrimination in insurance. Ethnicity is not a permissible underwriting factor in itself. Another incorrect approach would be to ignore the applicant's disclosed medical history and proceed with standard underwriting as if no significant health issues were present. This fails to fulfill the underwriter's fiduciary duty to the insurer to accurately assess risk and could lead to adverse selection, where individuals with higher risks are more likely to seek insurance, ultimately impacting the insurer's financial stability and potentially leading to higher premiums for all policyholders. A third incorrect approach would be to request unnecessary or intrusive personal information unrelated to mortality or morbidity risk, such as details about the applicant's social or political affiliations. This not only violates privacy concerns, but also demonstrates a lack of understanding of permissible underwriting criteria, potentially leading to regulatory scrutiny and reputational damage. Professional reasoning. Professionals should employ a systematic risk assessment process that begins with a comprehensive understanding of the applicant's disclosed information. This involves identifying all relevant risk factors and evaluating them against established underwriting guidelines and regulatory prohibitions. When faced with information that could be misconstrued or lead to discriminatory practices, the underwriter must consult internal guidelines, legal counsel, or senior underwriting management to ensure compliance. The decision-making process should prioritize objective data, individual assessment, and adherence to all applicable laws and ethical standards, ensuring fairness to the applicant and solvency for the insurer. Question 14. The risk matrix shows an increased likelihood of claims involving advanced retinal imaging technology for routine eye examinations. The policy document for a specific group plan states that routine eye examinations are covered annually, including standard diagnostic tests for vision correction. It also excludes experimental or investigational treatments and diagnostic tests not directly related to vision correction. The provider has submitted a claim for advanced retinal imaging, citing its ability to detect early signs of various eye diseases, some of which are not directly related to vision correction, but can impact overall eye health. What is the most appropriate approach for determining coverage? Option A. Approve the claim, as the advanced retinal imaging is a diagnostic test that provides valuable information about the patient's eye health, and the policy covers routine eye examinations. Option B. Approve the claim, as the provider has recommended the service for the patient's overall eye health, and it is standard practice for many ophthalmologists to utilize such technology. Option C. Deny the claim, as the advanced retinal imaging is considered experimental technology and is not explicitly listed as a covered diagnostic test for vision correction. Option D. Review the policy's specific definitions of routine eye examinations and diagnostic tests for vision correction, and analyze whether the advanced retinal imaging service, as described by the provider, falls within the scope of covered benefits or is subject to specific exclusions or limitations, while also considering any applicable state regulatory guidance on diagnostic imaging in vision care. The correct answer is A. Approve the claim, as the advanced retinal imaging is a diagnostic test that provides valuable information about the patient's eye health, and the policy covers routine eye examinations. Explanation. The scenario presents a common challenge in vision insurance underwriting and claims review, distinguishing between covered services and those that are excluded or limited, particularly when advanced diagnostic technologies are involved. The professional challenge lies in accurately interpreting policy language, understanding the intent behind coverage limitations, and applying these to evolving medical technology, all while adhering to regulatory requirements and ethical obligations to both the insurer and the insured. Misinterpretation can lead to improper claim denials, customer dissatisfaction, and potential regulatory scrutiny. The correct approach involves a thorough review of the specific vision insurance policy's covered services, limitations, and exclusions, cross-referenced with the relevant state insurance regulations governing vision benefits and claims handling. This approach prioritizes adherence to the contractual agreement between the insurer and the policyholder, ensuring that coverage decisions are based on the defined terms of the policy and are compliant with applicable laws. Specifically, it requires understanding if the advanced diagnostic imaging, while medically beneficial, falls outside the defined scope of routine eye examinations or diagnostic tests for vision correction, as outlined in the policy, or if it is subject to specific limitations such as frequency or medical necessity criteria that have not been met. Regulatory compliance ensures fair treatment of policyholders and prevents discriminatory practices. An incorrect approach would be to approve the claim solely based on the medical necessity or the provider's recommendation without a detailed policy review. This fails to uphold the contractual obligations of the insurance policy and could lead to financial losses for the insurer by covering services not intended to be included. It also risks setting a precedent for future claims that deviates from established policy terms, potentially leading to disputes and regulatory issues related to misrepresentation of benefits. Another incorrect approach would be to deny the claim solely because the technology is considered advanced or experimental, without consulting the policy's specific exclusion clauses or limitations. Many policies define exclusions more narrowly than simply advanced technology. If the technology is used to diagnose a condition that is otherwise covered, or if it is a standard diagnostic tool for a covered condition, it may still be payable. This approach risks an arbitrary denial that does not align with the policy's intent or regulatory guidance on claim adjudication. A third incorrect approach would be to approve the claim without verifying if the provider has met any pre-authorization or referral requirements stipulated in the policy. Vision insurance policies often have specific procedures for accessing certain diagnostic services, especially those involving specialized equipment. Failing to verify these requirements can lead to improper payments and potential disputes with the provider. The professional decision-making process for similar situations should involve a systematic review. 1. Understand the policy contract. Carefully read the vision insurance policy document, paying close attention to definitions of covered services, limitations e.g., frequency, scope, and specific exclusions. 2. Identify the service provided. Clearly understand the nature of the diagnostic imaging service rendered by the provider. 3. Cross-reference service with policy. Determine if the service aligns with covered benefits, falls under limitation, or is explicitly excluded. 4. Consult regulatory guidance. Review applicable state insurance department regulations and guidelines pertaining to vision benefits, diagnostic services, and claim handling. 5. Seek clarification. If policy language is ambiguous or if the service is borderline, consult with internal underwriting, claims, or legal departments for interpretation. 6. Make a compliant decision. Render a decision based on the comprehensive review of the policy and regulations, communicating the outcome clearly and professionally to the policyholder and provider. Question 15. Performance analysis shows that a significant number of long-term care insurance policies are being issued with benefit structures that do not fully align with the stated needs of the policyholders at the time of application. Considering the regulatory framework for the FALU, Academy of Life Underwriting (FALU) exam, which approach best ensures that a policy's benefit triggers, levels of care, elimination period, benefit period, and inflation protection are appropriately matched to the applicant's anticipated future needs and understanding. Option A. Proactively explaining the nuances of various benefit triggers, detailing the implications of different levels of care covered, clearly outlining the trade-offs between shorter and longer elimination and benefit periods, and providing a comprehensive overview of the cost and coverage impact of different inflation protection options, ensuring the applicant understands how these features will function in a claim scenario. Option B. Focusing the explanation primarily on the most common benefit trigger, e.g., inability to perform 2 ADLs, and briefly mentioning other triggers without in-depth discussion, assuming the applicant will understand the broader implications. Option C. Recommending the shortest possible elimination period and longest possible benefit period to maximize immediate benefit access and coverage duration, as this is generally perceived as the most comprehensive coverage. Option D. Presenting all available inflation protection options without detailing their long-term premium increases or the specific percentage of benefit growth they provide, as the applicant can research these details independently. The correct answer is A. Proactively explaining the nuances of various benefit triggers, detailing the implications of different levels of care covered, clearly outlining the trade-offs between shorter and longer elimination and benefit periods, and providing a comprehensive overview of the cost and coverage impact of different inflation protection options, ensuring the applicant understands how these features will function in a claim scenario. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an underwriter to balance the client's stated needs and understanding of long-term care insurance, LTCI, with the regulatory requirements and the inherent complexities of benefit triggers, levels of care, elimination periods, benefit periods, and inflation protection. Misinterpreting or misapplying these features can lead to a policy that either fails to provide adequate coverage when needed or imposes unnecessary costs and complexities on the client, potentially leading to regulatory scrutiny or client dissatisfaction. The underwriter must ensure the policy design aligns with the client's expectations and the policy's intended purpose, while adhering strictly to the FALU exam's specified regulatory framework. Correct approach analysis. The correct approach involves a thorough review of the client's stated needs and a clear explanation of how the proposed LTCI policy's benefit triggers, e.g., cognitive impairment, inability to perform a certain number of activities of daily living ADLs, defined levels of care, e.g., skilled nursing, intermediate care, custodial care, elimination period, the waiting period before benefits begin, benefit period, the maximum duration of benefits, and inflation protection options, e.g., simple, compound, will function in practice. This approach ensures that the policy's features are accurately communicated and appropriately matched to the client's anticipated future needs, thereby fulfilling the underwriter's duty to provide suitable coverage and comply with regulatory guidelines that emphasize consumer understanding and fair treatment. The FALU exam's jurisdiction emphasizes clear disclosure and suitability, making this comprehensive explanation and alignment the only professionally sound method. Incorrect approaches analysis, an approach that focuses solely on the most common benefit trigger without exploring the client's specific risk profile for different types of cognitive or physical impairment, is incorrect. This fails to adequately assess suitability and may lead to a policy that does not respond to the client's actual future care needs, potentially violating regulations requiring policies to be appropriate for the applicant. An approach that presents all available inflation protection options without explaining their long-term cost implications and impact on benefit levels is also incorrect. This lacks the necessary disclosure and guidance for the client to make an informed decision, potentially leading to unexpected premium increases or inadequate benefit growth, which can be viewed as a failure to act in the client's best interest and a violation of disclosure requirements. An approach that simplifies the explanation of the elimination period and benefit period by focusing only on the shortest possible options without discussing the trade-offs in premium cost and benefit duration is professionally deficient. This omits crucial information that impacts the policy's overall value and cost-effectiveness, potentially misleading the client and failing to meet regulatory standards for clear and complete policy explanation. Professional reasoning. Professionals should adopt a client-centric, compliance-focused approach. This involves actively listening to and understanding the client's stated needs and concerns, and meticulously explaining how each feature of the LTCI policy, benefit triggers, levels of care, elimination period, benefit period, inflation protection, directly addresses those needs and aligns with regulatory expectations. This requires a deep understanding of the policy contract and the relevant regulatory framework. When faced with complex policy features, the professional should prioritize clarity, accuracy, and suitability, ensuring the client can make an informed decision. If there is any doubt about the client's understanding or the suitability of the policy, further discussion or consultation is warranted, always prioritizing ethical conduct and regulatory compliance. Question 16. Implementation of Health Savings Account, HSA. Eligibility assessment requires an underwriter to consider multiple factors beyond just the existence of a high-deductible health plan. Considering the U.S. Internal Revenue Code, IRC, Section 223, which of the following scenarios accurately reflects an individual's eligibility to contribute to an HSA? Option A. An individual is covered by a high-deductible health plan, HDHP, and also enrolled in Medicare. Option B. An individual is covered by an HDHP and also has coverage under a spouse's non-HDHP employer-sponsored health plan. Option C. An individual is covered by an HDHP and has elected to receive care through a health maintenance organization, HMO, that meets the HDHP minimum deductible and maximum out-of-pocket limits. Option D. An individual is covered by an HDHP and has supplemental health insurance that covers specific services not included in the HDHP, but does not provide coverage for medical expenses before the HDHP deductible is met. The correct answer is A. An individual is covered by a high-deductible health plan, HDHP, and also enrolled in Medicare. Explanation. This scenario is professionally challenging because it requires an underwriter to navigate the nuanced eligibility requirements for health savings accounts, HSA, within the specific regulatory framework governing the Fellow Academy of Life Underwriting, FALU, exam. Misinterpreting these requirements can lead to incorrect underwriting decisions, potentially impacting the applicant's ability to access tax-advantaged healthcare savings and violating regulatory compliance. Careful judgment is required to distinguish between individuals who meet the criteria for HSA eligibility and those who do not, particularly concerning other health coverage. The correct approach involves accurately assessing the applicant's health coverage status against the IRS guidelines for HSA eligibility. Specifically, an individual must be covered by a high-deductible health plan, HDHP, and have no other health coverage that is not an HDHP. This includes Medicare, TRICARE, or other employer-sponsored health plans that do not meet the HDHP definition. The underwriter must verify that the applicant's existing health coverage, if any, does not disqualify them from establishing and contributing to an HSA. This aligns with the Internal Revenue Code, IRC, Section 223, which defines HSA eligibility. An incorrect approach would be to assume HSA eligibility based solely on the presence of a high-deductible health plan without verifying the absence of disqualifying other health coverage. This fails to adhere to the comprehensive eligibility criteria outlined by the IRS. Another incorrect approach would be to overlook the requirement that the individual cannot be enrolled in Medicare. Medicare is considered disqualifying other health coverage for HSA eligibility, and its presence would render the applicant ineligible. Finally, assuming that any health coverage is acceptable as long as it is a high-deductible plan, without considering the no other disqualifying coverage rule, is a critical regulatory failure. Professional decision-making in similar situations requires a systematic review of all relevant eligibility criteria as defined by the governing regulations. This involves not only understanding the primary requirement, HDHP coverage, but also thoroughly investigating any secondary or exclusionary conditions, e.g., other health coverage. Medicare enrollment. Underwriters should consult official IRS guidance and relevant publications to ensure accurate interpretation and application of the rules. When in doubt, seeking clarification from compliance or legal departments is a prudent step to maintain regulatory adherence and uphold professional standards. Question 17. Which approach would be most appropriate for an underwriter when evaluating an indexed annuity application, where the client expresses interest in potential market-linked growth, but also seeks protection against market downturns, considering the underwriter's duty to ensure suitability and compliance with disclosure requirements? Option A. Thoroughly explain the indexed annuity's crediting methodology, including the specific index used, the calculation of credited interest based on the participation rate and cap, and the protection offered by the floor, while also assessing the client's financial objectives and risk tolerance. Option B. Recommend a fixed annuity instead, as indexed annuities are too complex to underwrite and explain effectively to clients seeking guaranteed growth and protection. Option C. Emphasize the guaranteed principal protection offered by the floor, downplaying the impact of the cap and participation rate on the potential upside, to assure the client of safety. Option D. Focus on the potential for uncapped growth, highlighting the participation rate as the primary driver of returns, and briefly mention the floor as a general safety net. The correct answer is D. Focus on the potential for uncapped growth, highlighting the participation rate as the primary driver of returns, and briefly mention the floor as a general safety net. Explanation. This scenario presents a professional challenge because the underwriter must balance the client's desire for potential growth with the inherent complexities and risks associated with indexed annuities, ensuring full disclosure and suitability. The underwriter's primary responsibility is to assess risk accurately and to ensure that the product recommended or underwritten aligns with the client's financial objectives and risk tolerance, adhering strictly to the regulatory framework governing life insurance and annuity products. The correct approach involves a thorough understanding of the indexed annuities crediting methods, including participation rates, caps, and floors, and clearly communicating these features to the client. This ensures the client understands the potential upside, the limitations on that upside, and the downside protection offered. Regulatory frameworks, such as those enforced by state insurance departments in the U.S., mandate that insurers and their agents provide accurate and complete information about annuity products, including all fees, charges, and crediting mechanisms. This approach upholds the principles of suitability and fair dealing, preventing misrepresentation and ensuring the client makes an informed decision. An incorrect approach would be to overemphasize the potential for high returns without adequately explaining the impact of caps and participation rates on actual credited interest. This failure to disclose material information violates regulations requiring full and fair disclosure, potentially leading to a finding of misrepresentation or omission. Another incorrect approach would be to present the floor as a guarantee of principal protection without clarifying that it applies to the credited interest and not necessarily the entire contract value if surrender charges are involved or if the annuity has specific riders. This misrepresentation of the product's guarantees can lead to client dissatisfaction and regulatory scrutiny for misleading sales practices. A third incorrect approach would be to recommend an indexed annuity without assessing the client's financial situation, risk tolerance, and investment objectives, thereby failing to meet the suitability requirements mandated by most regulatory bodies. This can result in the client purchasing a product that is not appropriate for their needs, leading to potential financial harm and regulatory penalties. Professionals should employ a decision-making framework that prioritizes client education and transparency. This involves 1. Understanding the product's mechanics in detail. 2. Assessing the client's profile against the product's features and risks. 3. Clearly and comprehensively explaining all aspects of the product, including limitations and potential outcomes under various market conditions. And 4. Documenting the suitability assessment and client disclosures. This systematic process ensures compliance with regulatory obligations and ethical standards. Question 18. The analysis reveals that a prospective client, seeking long-term cash value accumulation and tax deferral, has expressed interest in a variable universal life (VUL) insurance policy. The client has a moderate risk tolerance and limited investment experience. Which of the following approaches best aligns with regulatory requirements and ethical underwriting practices for this scenario? Option A. Emphasize the tax-deferred growth potential and the flexibility of premium payments, while providing a general overview of investment options without delving into specific risk scenarios. Option B. Recommend a fixed universal life policy instead, citing the client's limited investment experience as a reason to avoid the complexities and risks associated with VUL. Option C. Conduct a comprehensive assessment of the client's financial objectives, risk tolerance, investment knowledge, and understanding of VUL's investment component, clearly explaining the potential for both gains and losses and the impact of fees and charges. Option D. Focus on the death benefit protection aspect of the policy, highlighting its tax-free nature, and briefly mention the cash value as a secondary benefit with minimal detail on its investment performance. The correct answer is A. Emphasize the tax-deferred growth potential and the flexibility of premium payments, while providing a general overview of investment options without delving into specific risk scenarios. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the client's stated objectives with the inherent complexities and risks of variable universal life (VUL) insurance, particularly concerning the interplay between investment performance and policy guarantees. The underwriter must ensure that the product recommendation aligns with the client's risk tolerance, financial sophistication, and long-term goals, while also adhering to regulatory requirements designed to protect consumers from misrepresentation and unsuitable product sales. The correct approach involves a thorough assessment of the client's financial situation, investment experience, and understanding of VUL's investment component and associated risks. This includes clearly explaining the potential for investment gains and losses, the impact of fees and charges, and the policy's cash value performance relative to premiums paid. Regulatory justification stems from principles of suitability and fair dealing, ensuring that the product is appropriate for the client's circumstances and that all material information is disclosed. This aligns with the underwriter's fiduciary duty to act in the client's best interest. An incorrect approach of focusing solely on the potential for tax-deferred growth without adequately addressing the investment risk and volatility would be a regulatory failure. This misrepresents the product's nature and could lead to a policy that does not meet the client's needs or expectations, potentially violating regulations against misleading sales practices. Another incorrect approach of downplaying the impact of policy charges and fees on long-term cash value accumulation would also be a significant ethical and regulatory lapse. This failure to disclose the full cost structure can lead to a policy that underperforms expectations and may not be sustainable for the client, breaching disclosure requirements. Finally, recommending VUL without confirming the client's understanding of the variable nature of the underlying investments and the potential for cash value to decline below the amount paid in premiums would be a failure to ensure suitability, a core regulatory tenet. Professionals should employ a decision-making framework that prioritizes client understanding and suitability. This involves a structured needs analysis, a clear explanation of product features and risks, and a verification of client comprehension. The process should be documented to demonstrate due diligence and adherence to regulatory standards. Question 19. Operational review demonstrates that an underwriter is considering an applicant for a substantial life insurance policy. The applicant has disclosed a history of a chronic but well-managed medical condition. To assess the mortality risk accurately, the underwriter is contemplating requesting detailed financial statements from the applicant's business, information about their social media activity, and a comprehensive list of all past and present recreational activities, including participation in extreme sports. Which of the following approaches best aligns with underwriting principles and practices within the United States regulatory framework? Option A. Request detailed medical records pertaining to the disclosed chronic condition and inquire about any recreational activities that could be considered high risk, while ensuring all information gathering complies with privacy regulations and is directly relevant to mortality risk. Option B. Request detailed financial statements from the applicant's business and a comprehensive list of all past and present recreational activities, including participation in extreme sports, to gauge their risk-taking propensity. Option C. Rely on publicly available information about the applicant's general health trends and make an underwriting decision based on statistical averages for their demographic group. Option D. Obtain the applicant's full credit report and a detailed analysis of their social media profiles to assess their overall lifestyle and potential for future health issues. The correct answer is A. Request detailed medical records pertaining to the disclosed chronic condition and inquire about any recreational activities that could be considered high risk, while ensuring all information gathering complies with privacy regulations and is directly relevant to mortality risk. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the insurer's need for accurate risk assessment with the applicant's right to privacy and fair treatment, all within the specific regulatory framework of the United States life insurance industry. The underwriter must exercise careful judgment to ensure that the information gathered is both relevant to the underwriting decision and obtained ethically and legally. The correct approach involves a thorough review of the applicant's medical history and lifestyle factors that are directly and demonstrably related to the mortality risk being underwritten. This aligns with the principle of underwriting for adverse selection, ensuring that premiums accurately reflect the risk presented by the insured. Specifically, it requires the underwriter to seek information that is material to the insurability of the applicant, and to do so in a manner that complies with state insurance laws and federal regulations such as HIPAA, which govern the disclosure and use of protected health information. The underwriter must also adhere to the NAIC Unfair Trade Practices Act, which prohibits misrepresentation and deceptive practices in the insurance business, ensuring that the underwriting process is transparent and fair. An incorrect approach would be to request information that is not directly relevant to the mortality risk, such as details about the applicant's financial investments unrelated to their ability to pay premiums or their general social activities that do not pose a discernible health risk. This would violate the principle of proportionality in information gathering and could be construed as intrusive or discriminatory, potentially leading to violations of privacy laws and fair underwriting practices. Another incorrect approach would be to rely solely on readily available public information without conducting a proper underwriting investigation, especially if that information is outdated or incomplete. This could lead to an inaccurate assessment of risk and potentially expose the insurer to adverse selection. It also fails to meet the underwriter's duty to gather sufficient information to make an informed decision. A further incorrect approach would be to make an underwriting decision based on assumptions or stereotypes rather than on objective, verifiable information directly related to the applicant's health and mortality risk. This is ethically unsound and can lead to discriminatory practices, which are prohibited by law. The professional decision-making process for similar situations should involve a systematic evaluation of the information required, its relevance to the underwriting decision, the legal and ethical implications of obtaining and using that information, and the potential impact on the applicant. Underwriters should always prioritize obtaining information that is material to the risk, obtained through appropriate channels, and used in a fair and non-discriminatory manner, consistent with all applicable regulations. Question 20. Operational review demonstrates that a client's employer sponsors a retirement plan that provides a guaranteed retirement benefit based on a formula of salary and years of service. The plan also includes a life insurance death benefit for participants. The underwriter is asked to assess the risk associated with the life insurance component. Which of the following is the most appropriate underwriting approach? Option A. Underwrite the life insurance death benefit based on the individual participant's health and mortality risk, as this is a separate insurance policy purchased by the plan trust for participant benefit. Option B. Underwrite the life insurance death benefit by considering the overall funding status and actuarial projections of the retirement plan, as the death benefit is an integral part of the employer's retirement funding obligation. Option C. Underwrite the life insurance death benefit as a general employee benefit, with underwriting standards applied to the employer group rather than individual participants. Option D. Underwrite the life insurance death benefit by assessing the employer's financial stability and ability to meet its retirement obligations, as this directly impacts the longevity of the benefit. The correct answer is A. Underwrite the life insurance death benefit based on the individual participant's health and mortality risk, as this is a separate insurance policy purchased by the plan trust for participant benefit. Explanation: this scenario presents a professional challenge because it requires the underwriter to navigate the complexities of qualified retirement plans, specifically distinguishing between defined benefit and defined contribution plans, while adhering strictly to the regulatory framework governing life insurance products and their integration with such plans. The underwriter must ensure that any recommendations or underwriting decisions are compliant with relevant tax laws and ERISA, Employee Retirement Income Security Act, principles, even if not directly administering the plan. Misinterpreting the nature of the plan or its funding mechanisms could lead to incorrect underwriting assumptions, potentially resulting in adverse selection or noncompliance. The correct approach involves accurately identifying the retirement plan as a defined contribution plan, specifically a 401(k) plan, and understanding that the death benefit is typically a separate insurance policy purchased by the trust for the benefit of the plan participants. This means the underwriting of the death benefit should be based on the individual participant's health and risk factors, independent of the plan's funding status or actuarial assumptions. This aligns with regulatory expectations that life insurance underwriting for individual policies, even when sponsored by an employer as part of a qualified plan, must be based on sound underwriting principles and individual risk assessment, not on the plan's overall financial health or actuarial projections. An incorrect approach would be to assume the death benefit is directly tied to the plan's actuarial surplus or deficit, as might be the case in a defined benefit plan, where the employer guarantees a specific benefit. Underwriting based on the plan's funding status would be a regulatory failure, as it deviates from individual risk assessment and could lead to discriminatory practices or misrepresentation of the policy's value. Another incorrect approach would be to treat the death benefit as a general asset of the employer, rather than a benefit for plan participants. This would violate ERISA fiduciary duties and the principle that plan assets are held for the exclusive benefit of participants and beneficiaries. The professional decision-making process for similar situations requires a thorough understanding of the specific qualified retirement plan in question, its structure, and how life insurance benefits are integrated. This involves consulting plan documents, seeking clarification from plan administrators or legal counsel if necessary, and applying established underwriting guidelines for individual life insurance policies. The underwriter must prioritize compliance with all applicable regulations and ethical standards, ensuring that underwriting decisions are objective, fair, and based on individual risk assessment.